Andrei Jikh is a popular YouTube personality and investor known for his informative and engaging videos on personal finance, investing, and entrepreneurship. He has built a sizable following through his content, which has helped many people gain a better understanding of the financial world. But how did he become successful? The answer lies in his investing principles. Hi, welcome to Taurus Treasury, and in this video, we'll be discussing the top 5 investing lessons we can learn from Andrei Jikh. So let's dive in. Number 1. Don't invest if you are not ready. One of his key pieces of advice Andrei Jikh gives is that you shouldn't start investing until you're ready. While this may seem counterintuitive to some, there are several reasons why Jikh believes this is true. First and foremost, investing requires a certain level of financial stability and security. If you're living paycheck to paycheck or struggling to pay off debt, you may not have the extra funds or mental bandwidth to dedicate to investing. In this case, Jikh recommends focusing on building an emergency fund, paying down debt, and improving your overall financial health before diving into the world of investing. In addition, investing can be complex and intimidating, especially for those who are new to the game. It requires a certain level of knowledge and skill to make informed decisions about which assets to invest in and how to manage your portfolio effectively. Without this knowledge and skill, you may be at risk of making costly mistakes that could negatively impact your finances. So, how can we learn from Jikh's advice? One key takeaway is to prioritize financial stability and education before investing. This means taking the time to build up an emergency fund, pay down debt, and educate yourself about the fundamentals of investing before jumping in. For example, let's say you're a recent college graduate who wants to start investing. Instead of immediately funneling your extra funds into the stock market, take some time to build up your emergency fund and pay off any student loans or credit card debt you may have. You can also take advantage of free resources online, like Jikh's YouTube channel, to learn more about investing before making any major decisions. Number 2. Invest in what you know. Investing in what you know is a popular piece of advice given by many successful investors, including Andrei Jikh. The reasoning behind this is simple. When you invest in a company or industry that you understand well, you are better equipped to make informed decisions, assess risks, and evaluate potential opportunities. This can lead to more successful investments and better long-term outcomes. Investing in what you know can also help you avoid common pitfalls, such as investing in a company solely based on its popularity or hype, rather than its actual financials and prospects. It can also help you stay on top of market trends and changes, as you are likely to have a deeper understanding of the underlying drivers of these trends. One example of this is the rise of the tech industry over the past few decades. Many successful investors, such as Warren Buffett, have famously avoided investing in tech companies as they felt that they did not understand the industry well enough to make informed decisions. Others, such as Peter Thiel and Mark Cuban, have made fortunes by investing in tech companies that they have a strong understanding of, such as PayPal and Broadcast.com, respectively. Learning from this advice involves developing a deep understanding of the companies and industries you are interested in investing in. This may involve researching financial statements and performance metrics, analyzing industry trends and developments, and keeping up to date with news and events that may impact your investments. It can also involve networking and building relationships with people who work in these industries, such as entrepreneurs, executives, and analysts. Investing in what you know is not a foolproof strategy, and it is important to be disciplined and rational in your decision-making. However, by developing a strong understanding of the companies and industries you invest in, you can increase your chances of making successful investments and achieving your long-term financial goals. Number 3. Diversification is key. Diversification is one of the most important principles of investing, and it is a key strategy that Andrei Jikh often discusses in his videos. Simply put, diversification means spreading your investments across a variety of different asset classes, industries, and geographic regions to minimize risk and increase the potential for long-term gains. The reason diversification is so important is that it helps to reduce the impact of any single investment on your overall portfolio. By investing in a range of assets, you can spread your risk and ensure that you are not overly exposed to any one company, industry, or market. Let's say that you invest all your money in a single stock. If that stock performs poorly or the company goes bankrupt, you could lose all your money. However, if you spread your money across a variety of stocks, bonds, real estate, and other assets, the impact of any single investment performing poorly will be much smaller. So how can we learn from Andrei Jikh's emphasis on diversification? The key is to build a portfolio that is diversified across a range of different asset classes, including stocks, bonds, and real estate. You can also diversify within each asset class by investing in a range of companies, industries, and geographic regions. If you're finding this video valuable, hit that subscribe button and share your thoughts in the comments section below. Number 4. Focus on long-term goals. In today's fast-paced and ever-changing world, it's easy to get caught up in the desire for immediate gratification and instant results. This is especially true when it comes to investing, where many people are tempted to make quick trades or chase hot stocks in the hopes of achieving rapid gains. However, Andrei advises that investors should focus on long-term goals instead. Why is focusing on long-term goals so important when it comes to investing? There are several reasons. First, the stock market is notoriously unpredictable in the short term. Trying to time the market or make short-term trades can be a recipe for disaster, as it's difficult if not impossible to predict the market's ups and downs. By focusing on long-term goals, investors can take a more patient and strategic approach, which can lead to more consistent and stable returns over time. Second, investing is a journey, not a destination. It's important to develop a clear investment strategy that is tailored to your individual financial situation and goals, and then stick to that strategy over time. This means avoiding knee-jerk reactions to market fluctuations or the latest investment fads, and instead staying the course and making adjustments as needed based on your long-term goals. Finally, we should always remember that investing is a journey, not a destination. It's important to stay focused on our long-term goals and not get sidetracked by short-term market fluctuations or the latest investment fads. By taking a patient and disciplined approach, we can achieve our financial goals and build a better future for ourselves and our families. Number 5. Keep your emotion in check. Investing can be a roller coaster ride of emotions. Emotions, such as fear and greed, can often cloud one's judgment when it comes to investing. One particular example that comes to mind when discussing this concept is the GameStop phenomenon that took place in early 2021. In late January 2021, retail investors banded together to push up the stock price of GameStop, a struggling video game retailer. This group of investors, largely organized on social media platforms like Reddit, drove the stock price up by over 1,000%, creating a frenzy in the investing world. Many retail investors, caught up in the excitement, bought GameStop shares without fully understanding the risks and potential consequences. However, as the hype around GameStop began to fade, the stock price quickly plummeted, causing many investors to suffer significant losses. Those who invested based on emotions rather than sound investment principles were left with a valuable lesson learned. From this example, we can learn that investing based on hype and emotion can be a recipe for disaster. It is essential to approach investing with a clear and rational mind, focusing on sound investment principles rather than trying to chase quick profits or follow the crowd. Diversification, a focus on long-term goals, and investing in what you know are some of the keys to successful investing. By taking a disciplined and rational approach to investing, you can minimize the impact of emotions and focus on making informed decisions based on sound investment principles. So next time you feel the urge to jump on a hot stock or sell everything in a market downturn, take a deep breath, count to 10, and remember Andrei's wise advice. Keep your emotions in check. Thank you for joining us today. Don't forget to subscribe and leave your thoughts in the comments section below.